Chapter 9, Problem 9.20. The following. The Merino Company manufactured training high-quality, moderately priced watches. As Merino's senior financial analyst, you are asked to recommend a method of inventory costing. The CFO will use your recommendation to prepare Merino's 2014 income statement. The following data are for the year ended December 31st, 2014. Assume standard costing per unit are the same for units in the beginning inventory and units produced during the year. Also assume no price, spending, or efficiency variance. Any production value variances is written off to the cost of goods sold in the month in which it occurs. There are 4 requirements to complete this problem. Requirement number 1, prepare income statement under variable and absorption costing for the year ended December 31st, 2014. Requirement number 2, what is Merino's operating income as a percentage of revenues under each costing method? Explain the difference in operating income between the two methods. Which costing method will you recommend to the CFO and why? Given the following table, there are 90,000 units in the beginning inventory of January 1st, 2014. There are 33,000 units in the ending inventory December 31st, 2014. 2014 sales consisted of 340,000 units. Selling price was $25 per unit. Variable manufacturing cost per unit, including direct material, was $4.80 per unit. Variable operating marketing cost per unit sold was $1.80 per unit sold. Fixed manufacturing cost is $1,268,500. Your denominator level machine hours is 5,900 hours. Standard production rate is $50 units per machine hours. And your fixed operating marketing cost was $1,050,000. Now, to set up your variable costing income statement, you must first prepare a formula. What I did was I have created a template with pre-filled information already. This problem is very lengthy. So to begin this problem, I have set up beginning inventory plus 2014 production, which is equal to my 2014 sales plus my ending inventory. Now, in this table, it provided beginning inventory of $90,000, 90,000 units, and I add to my 2014 production. Now, 2014 production is what I'm trying to solve for, which is equal to 340,000 units 2014 sales plus my 33,000 units in ending inventory. What I did was I set it up algebraically. I moved the 90,000 units to the other side of the equation. Now, by taking $340,000, adding to 33,000 ending inventory, subtracted by the 90,000 beginning inventory units, I came up with 283,000, which is my 2014 production. Now, going to the variable costing statements, I took $25,000, which was given in the table, and I multiplied that by my 2014 sales unit. That gives me $8,500,000 for revenue. And then for the cost of goods sold for variable, I have to break it down from beginning inventory and then variable manufacturing costs, manufacturing overhead costs, which gives me $4.80. This was already provided to me in the table. So I took $4.80 per unit and I times it by my 90,000, which is my beginning inventory, and that gives me $432,000. Now to get my variable manufacturing overhead cost, I took the $4.80 per unit and I multiply it by what I have solved for in my previous formula, which was the $283,000 for 2014 production. And that gave me $1,358,400. Now to get the cost of goods sold available for sale, what I did was I simply sum up beginning inventory plus variable manufacturing overhead costs. So that gave me $1,790,400. And then to get my any inventory, I took $4.80 per unit and I times it by my any inventory of 33,000 units. Now, because it's deduct any inventory, I do want to show this as a negative sign. For variable cost of goods sold, what I simply did was I took the $1,790,400 and I subtracted from any inventory total. Which gave me $1,632,000. Now to get my variable operating costs, I took my variable operating cost per unit sold, which was $1.80, and I multiplied that by my 2014 sales, which was $340,000. That gave me $612,000. And for the adjustment for variance, we don't have anything for variable costing, so that gives me 0. And then moving on to find the total variable cost, what I simply did was I took my variable cost of goods sold, which is $1,632,000, and I added to my variable operating cost, which gave me $2,244,000. And then to get my contribution margin, I simply took my revenue and I subtracted from my total variable cost, which gives me $6,256,000. And to find out what I have for fixed costs, I took the number given up here, which was 1,268,500, and I simply brought it down here. And then for my fixed operating cost, which was given to me in the table, which is 1,050,000. And with that, I summed that up. I took those two numbers. And that gave me $2,318,500. Once I get that, I took the $6,256,000 and I subtracted by the $2,318,500, and that gave me a total of $3,937,500 for operating income. And that would be my operating income for variable costs. Moving on to my absorption costing. Now, in order to do the absorption costing for to do the income statement, you must first find your fixed manufacturing overhead allocation rate per unit. To do that, what I did was I took my fixed manufacturing overhead allocated rate of $1,268,500, and I divide that into my denominator level machine hour, which was the 5,900 hours. That gave me $215 per machine. And then I also need to find my fixed manufacturing allocated rate per unit. To do that, I took my fixed manufacturing overhead allocated rate divided by my standard production rate. That gave me $4.30. So basically what I did was I took $215 divided by $50, which was the rate for my standard production rate. That gave me $4.30. And then from there on, I needed to find my production value variances. To find the production value variances, I took 5,900 hours times it by my $50, which is the standard production rate, which gave me 295,000. And then I subtracted to 283,000, which was my 2014 production. There was a difference of 12,000. The 12,000, I will use that 12,000 to times that by the 4.3, which is my new fixed manufacturing overhead allocated rate per unit. And I'll show you where these numbers go to in the following diagram. So for revenue absorption costing, I took $25 and I times it by 340,000 units. That gave me $8,500,000. To find beginning inventory, I took what was given to me in here, which was the $4.80 per unit, and that added to my $4.30, which is my fixed manufacturing allocated rate per unit. And I'm going to times that I'm going to add those two numbers up. That comes up to 4.8 plus 4.3. That equals $9.10. With $9.10, I'm going to times that by the $90,000, the 90,000 units. Which gives me 819,000 in beginning inventory. Now to find variable manufacturing costs, overhead, now to find variable manufacturing overhead costs, I took $4.80 per unit and I multiplied that by 283,000, which was my 2014 production. That gave me $1,358,400. Now, to find my allocated fixed manufacturing overhead costs, I simply took $4.30, which is the fixed manufacturing allocated rate per unit, and I times it again by my 2014 production of $283,000. And that gave me $1,216,900. Now to find my cost of goods sold, what I did was I basically summed all three of them up. Beginning inventory, variable manufacturing overhead costs plus allocated fixed manufacturing overhead costs. And that gave me $3,394,300. Now, to get my deduct any inventory, again, I took $4.80 plus $4.30. That gave me $9.10. And I'm going to times that by my 33 any inventory units. And that gives me 300,000 and 300,300. Now remember how I was telling you that 12,000, I was going to show you where I'm going to use that 12,000 from? Well, to find the adjustment for production value variances, we found that over here by taking 295,000 in this area right here. By taking 295,000, subtracting 283,000, which gives us a difference of $12,000. And I'm going to times that by the $4.03 for my fixed manufacturing allocated rate per unit. And that gives me $51,600. Unfavorable. And I'll show you why it's unfavorable. Basically, you can compare the $295,000 with the $280,000. There's a difference of $12,000, so that's why it's unfavorable. But most likely, you want to compare with this number right here. This number right here, we budgeted for $2,068,500. Okay, for fixed manufacturing overhead. That's what we budgeted for. However, when we come down here, this number that I highlighted in green, this is $1,221,900. $1,216,900. That number is smaller from my budgeted. My budgeted is much bigger. That's why it is unfavorable. There's a difference. Now for cost of goods sold, what I simply did was I sum up these numbers up. That's what I did. Now because the deduct in inventory, I do want to show this as a negative number, so I'm going to go back and we show that as a negative number. And that way, when you do your cost of goods sold, you would know that you need to subtract any inventory out. So that gave me, for cost of goods sold, it was $3,145,600. Now to get gross margin, what I did was I took the revenue of $8,500,000 and I subtracted from the cost of goods sold. That gives me $5,354,400. Moving on to my variable operating costs, I took my $1.80, which was given to me up here. Variable operating cost per unit sold, which is $1.80. I took that number and I'm going to multiply that by my $340,000, 340,000 units. That gives me $612,000. Now, to get my fixed operating costs, it's already given to me up in my table, which was the $1,050,000. I'm simply going to put that number, place it here. $1 million. Hold on. Now to get my total operating, To get my total operating, what I did was, this computer's going so slow on me. I sum up my variable operating costs plus my fixed operating costs. So that gave me $1,662,000. To get my operating income, what I did was I took my revenue, which is there's something wrong with my computer. It's very slow. 8,500,000. And I'm going to times that by my total operating. Now I'm sorry. I'm going to take my $8,500,000 and I'm going to subtract that from my total operating costs. Sorry guys, I had to stop the video because there was something wrong with my Excel. It wasn't responding. So let's get back to the problem again. For operating income, what I did was I took my gross margin and I subtracted by my total operating costs. That gives me $3,692,400. Now to do requirement number 3, because number 3 is asking you for the percentages. Let's see. Requirement number 2, it's asking you what is Merino's operating income as a percentages of revenue under each costing method. Now to do that, what I did was I took the $8,500,000 from variable costing. Okay, and I took operating income from variable costing. With those numbers, I took $3,937,500 and I divide that into the revenue. which gave me 46.3%. Now for the absorption costing, I took the revenue of absorption, and to get the operating income, which I've already got from the absorption income statement, which was the $3,692,400. To get the operating income as percentages of revenue, I took operating income divided by revenue. That gave me 43.4%. And then for explanation number 3, or requirement number 3, explain the difference in operating income between the two methods. Operating income uses operating costing, which is greater than operating income using absorption costing. The main difference between variable costing and absorption costing is the way in which fixed manufacturing costs are accounted for. So remember how I was telling you about that in absorption costing, there's fixed manufacturing overhead allocated rate, but for the variable costing, there is no fixed manufacturing variable overhead rate. That's one of the difference between variable costing and absorption costing, is in which fixed manufacturing costs are accounted. Now, requirement number 4, which costing method would you recommend to the CFO and why? You would recommend the absorption costing method. Should be recommended as it's consider all the manufacturing resources used to produce the units of output.